Hello, everyone. I'm very glad to be here, and I first want to thank the organizers for giving me the opportunity to chair this session. And it's an honor and my pleasure to introduce John Taylor, who is the Mary and Robert Raymond Professor of Economics at Stanford University, and George P. Schultz, Senior Fellow in Economics at Stanford University's Hoover Institution. Professor Taylor is a very known economist, but also has been Undersecretary of the Treasury for International Affairs, and he has a very good knowledge of monetary policy, and this is why he will speak today about econometric design, evaluation, and implementation of monetary policy. Professor Taylor, the floor is yours. You have around 50 to 60 minutes presentation, and then we will have questions from the participants.
Thank you much for the introduction. Thanks for inviting me to be here. Thanks in particular to Bank Al-Maghrib for helping so much. It's an honor to talk here about monetary policy, which is what I decided to do. I've been to Morocco a few times before. It's good to be back. Always is a very pleasant place. And it's part of many trips to Africa, which I think is a very important part of the world right now. I'm going to talk about monetary policy more generally. And I'm going to try to pick up on the idea that we have kind of a couple of important histories going on. Of course, the 60th anniversary of the Bank Al-Maghrib, and in addition, nearly the 90th anniversary of the Econometric Society. And so for that reason, I want to talk a little bit about some history of econometric models as used in monetary policy, and talk way back at the beginning, if you like, back to a period I'm going to call path space, in the 1930s, how that evolved into more rules analysis of policy. I'm going to talk about how central banks began to use this approach quite successfully, I think, in the 80s and 90s, in many countries beyond that, and then how there was a regression, less use of these types of models and approaches, and performance didn't do so well, in my opinion. And the lesson from that is we need to get back to a more, I'll call it, rules-based strategy for monetary policy. The interesting thing is, if you look carefully, as I try to do, in the last year, 2 years, or even less, you see kind of a revival of this rules-based approach to policy. And I want to talk a little bit about that, explain why it's happened, some of the key characteristics of it, and emphasize the international aspects of this. And in this respect, I'll pick up a little bit on what Chris Sims earlier said today. I think all these things have implications for econometric research and what econometricians do, what economists do more generally. So let me start with, I'll call it when it all began, the 1930s. Econometric Society, I think, officially started in 1930. But the first econometric model was built by Tinbergen back in 1936, and it was developed for monetary policy purposes. People forget that. It was designed to answer a question whether the Dutch guilder should be devalued and would that stimulate the economy. It was presented in 1936 at the Dutch Economics and Statistics Association. The paper was available a little before then. I think it's quite interesting that on 27th September, the Netherlands actually abandoned the gold parity and devalued the guilder by about 20%. So maybe this is one of the first times that an econometric model was actually proposed and used and delivered on a particular policy result. Whether you like it or not, it certainly was connected. You never can prove, by the way, and I've spent a lot of time in policy, you can never prove when an idea or a model is actually used in policy. It's very difficult to know, and many people have conjectures about that. Well, this is my conjecture. This was actually used for policy way back when. I think one characteristic of this early research And you can always see remnants of this as you look at research. It was very much what I'll call in path space. It was examining whether a particular path for the instruments, say a devaluation of the currency, had an effect on targets like the inflation rate or the GDP deflator or GDP itself. And the idea was to simulate the models with different scenarios or paths for the policy instruments, whether it was a devaluation exchange rate, whether Keynesian expansionary government purchases, or what have you. And then to look at the impact of this in a simulation of the model on the target variables. This was a very popular, influential approach. A whole Coles Commission and later foundation was established. People realized you needed to have ways to estimate these models. There was a difference between structural forms and reduced forms that was emphasized then, how to estimate structural equations, whether it's Fimmel-Limel or two-stage least squares. A lot of the simulations of these models were part of the debate between monetarists and Keynesians. And of course, it was used by many economists, including Lawrence Klein. What I think is also interesting for this talk is that it was not instantaneously that these models became adapted or used in central banks. And one of the most common uses was by the MIT Penn SSRC model at the Fed, MPS model, which didn't come in until the 1960s. So there's quite a bit of a lag, if you like, from the use of the models, from the development of the models to the usage. Now, what I think happened, in my view, looking back in time, is there was a paradigm shift in the way these models were used. And you can see it all over the place now. It almost goes without saying, but it's worth saying something about now. So the idea of path space, where you simulated a path for the money supply or the interest rate or the exchange rate, was translated into what I'll call rule space. And so now the policy, the examination is what would happen if you devalue or depreciated the currency or increased the money supply by X%. It would be what happened if you had a fixed exchange rate versus a flexible exchange rate system. What would happen if you widened the band, say, as in the case of Morocco, from a small amount to a larger amount? And this had antecedents, I think, before these models. Antecedent for me were people like A.W. Phillips, who is, of course, famous for the Phillips curve, but he also did extraordinary influential work on policies, rules for policies, feedback, integral, derivative types of controls. I think it also began because people like Milton Friedman had argued you just have a fixed money growth rule. It was realized, well, it wasn't just the fixed growth rate that was important about that, it was the rule itself, whether it was a feedback rule for the money supply or whatever. I think also, at least from my perspective, the important aspects that you need to think about models estimated in real time, where the models were being used for policy. I call it the joint estimation and control idea, that how you chose your instruments for policy, how you chose your policy rule, would affect how much you'd learn about the economy. And that was best done with rules, at least that's what I thought. And of course, the rational expectations critique, the Lucas critique, time inconsistency, Kidlin and Prescott, and the introduction of sticky prices made rational expectations an approach, and rational expectations was an approach that could be used in a fairly, I think, sophisticated way to examine monetary policy rules. So it wasn't just old-fashioned models. I listed some papers that were written way back when to illustrate that. This paradigm shift didn't occur instantaneously in central banks. It took a while. And one piece of evidence I think is important is the work which was done by Brian Hooper and Mann at the Brookings Institution, where they purposely looked at different types of model rules in different types of models. It was a very important robustness study. And so they were very purposely not looking at, say, one-time changes in the policy instrument. They were looking at policy rules, one of the first model comparisons things that did this. Also, it was necessary to overcome very difficult computational problems. At least they seemed to be difficult then. Maybe they're not so difficult now. Is how do you solve these forward-looking models where expectations of the future mattered for policy today? So it took a while, but eventually these were overcome. And by the early 90s, the MPS model was replaced by such things as FRBUS, we call FRBUS in the US. And examples of papers written about this in the 90s. And of course, the same kind of thing occurred at other central banks. Central bank, and I've noticed central bankers talk to each other, fortunately, around the world, so there's a spread of knowledge and information. So I could give many other examples of this same phenomenon, but this is the case of the Fed. So what happened at this point, I think, this is based on my own experience, is that since monetary policymakers are interested in practical advice about making policy, they can't think about every variable on earth. There was a way, almost a setback or a disappointment, that as the models became more complicated, so did the policy or the rules that seemed to be optimal in these models. It's natural to think once you have a very complicated model with lots of variables, that how you stabilize the economy is going to become complicated too. So that was kind of a setback, and I think raised serious doubts about a rules-based approach. And people began to ask, could a simple policy rule for the central bank be analyzed in these complicated models? And it turns out it could be. That's what I say, yes, exclamation. It's possible, and this is related to my own work to some extent, that you could have a reaction function where the central bank, say if its instrument was the interest rate, it could simply react to the inflation rate as long as the reaction coefficient was large enough, greater than 1. And 1.5 is one that I chose. Is it need to react to GDP, say the GDP gap, a measure of GDP relative to potential. That should be greater than 0. 0.5 was a good guess. And then there shouldn't really be necessary to react to other things, including the exchange rate, which was kind of a surprise, although the focus was more on the US. I had to guess what the equilibrium interest rate would be. 2% seemed reasonable, which with the inflation target of 2% made a 4% nominal interest rate as a normal level. So that gave rise to this, what I call bottom line approach, where the interest rate was simply equal to 1.5 times the inflation rate plus 0.5 times the GDP gap plus 1. And that's the so-called Taylor rule. And I emphasize by going through this exercise, this was not a curve-fitting exercise. This was not going around and estimating a reaction function. Indeed, if one estimated a reaction function back then, you would not get this kind of a thing because of the terrible policy in the 70s primarily. And then what was, I think, surprising, what's quite relevant for this talk here is this same idea, although the focus was originally the US and it was international models which we were using, the same idea applied to other countries. Not exactly, of course, countries are different. Reaction coefficients would be different. Maybe it would be important to react to exchange rates, and over time, what about other things as well? In many respects, this rules-based approach was important because it said you didn't have to react to everything, and what was omitted was as important as what was included. So this idea, now maybe there's a slight divergence, this idea that you could have this kind of a framework was quite robust, it seems to me. And thanks to some work by Volker Wieland at University of Frankfurt and myself have done some of this, we looked at lots of different models. And so this is just an example of the models that were in existence before the financial crisis of 2007, 8, and 9. And some were small and calibrated. Those are listed. Some of you may have heard of these or looked at these models. There are also some estimated models for the US. I've highlighted the ones in red because I want to look at those briefly for a minute. But again, a whole slew of models that people have used. And the de Grauw model had an accelerator in it, Smets-Vater, as you know, the Christian Eichenbaum Evans, it's sometimes called. This is the version here. And then there were models of the Euro area, models of small open economies. This particular group did not have a model for Morocco, but it had Chile, Canada, and Sweden. And then estimated models of the world, including a model I wrote down in 93. I list the red models because you can see what would happen and why there's some sense of which this was not just a random idea based on one model. You can simulate or calculate the policy responses to policy rules, such as this one. This is Smets-Vater's rule, where the interest rate, as you can see, reacts to inflation pi and the GDP gap y and its lag, then with a lag-dependent variable and then a monetary shock. and then see the impact of the shock. And so with the red models I chose just for comparison, you can see the impulse response function over on the left, the interest rate itself. It goes up and then fades away, and its impact on output, on inflation on the left. The magnitudes are not exactly the same, but they're, I think, remarkably similar along these models. So there was a sense in which this approach was a property of many models. These are pre-financial crisis, to be sure, and I'll come back to that in a minute. There were problems with this framework, still are, of course. One was it looked like only the federal funds rate or short-term interest rate affect the economy. Well, that's because of the simple 3-equation model or 4-equation model we sometimes use. Most models had a complicated analysis where the interest rate would affect long-term interest rates and exchange rate and credit growth and other things. So that was really not a good criticism, I think. And then there's a question, did it assume away financial frictions? Well, these models were not really good on financial frictions, although some did have a financial accelerator. And of course, there was a question of whether did it really deal with the zero lower bound, which is a hot topic now, which I'll come back to. In some sense, it did. Even back then, you had the Reif-Schneider-Williams approach that you had the zero bound taken care of by kind of a meta rule that when the interest rate hit zero, you would promise to hold it longer for a period of time was proportional, which the bound was there. So there's frameworks, problems of the framework, but not insurmountable. Now, I'm going to now talk about the history of the approach. So I think in many respects, this framework worked, at least compared to what was there before. Central banks did tend to move to more transparent, rules-based policies, including the inflation targeting movement. A lot of this was detected later by Clara Gell and Gertler, for example, where they looked at the behavioral decisions of central banks and found that it was quite similar to these simple policy rules. And as I mentioned, it was an incredible improvement compared to the high inflation and rising unemployment in many countries in the late 60s and 70s. Mervyn King became governor of the Bank of England, called the NICE period for non-inflationary, consistently expansionary, and many emerging market countries joined in this, including through inflation targeting, and I think it contributed to global stability. Now, inflation targeting itself is worth mentioning for a minute here, because in many respects, the way that had been implemented was with some policy rule. So I have a quote here from Jose Gregario, who was the governor of the Bank of Chile during or at least at the Bank of Chile during its move to inflation targeting. And he just says the inflation target is an efficient framework to conduct monetary policy. The issue then is how to operationalize this framework. When should monetary policy be tightened or loosened? The most traditional answer is the Taylor rule. Of course, he means more generally rules. But the idea is that you have to do something with the instruments of policy to make this work. You just can't wish it will happen. And then the Central Bank of Chile itself wrote the usual working assumption as a policy rule that associates the policy rate with the gap between projected and target inflation, as in the simple rule, and the output gap itself. So this idea that rules, strategies, I might call it more generally, becoming more common in central banks, I think applies with spades, although we don't always think of it that way, to inflation targeting central banks. That's what I want to say. Now, to continue this history and to get to where we are now, I think there was a big deviation from this approach, and I think it led to big problems. So that's my opinion based on research, which I'll talk about. So there was evidence that in somewhere around 2002, 3, 4, 5, don't know exactly when, there was a deviation from this approach to monetary policy. And I'll give you some charts to show that, but these are some examples of the people who discovered it. And this was before the financial crisis, sometimes called too low for too long. And it is supported by recent work by Jordan Sherlock and Alan Taylor, and by other people, which I'll try to show in a minute, including historians like Alan Meltzer. And there's also a global aspect to this, which I'll also refer to, that this deviation was not just one country, it was global. and we want to see why that was the case. It's very important. Okay, so here's some charts. This is an old chart from 2007, which shows the actual interest rate set by the Fed in light blue. This comes from the Economist magazine. It's just a facsimile of a chart in their magazine back in 2007. They're always clever with naming charts. This one was called Loose Fitting. And it basically just took what they had as an estimate of a policy rule. It happens to be the Taylor rule. It shows you how low interest rates were at that point. And so various people pointed that out, including me. This is a chart by economist at the Federal Reserve Bank of Kansas City, George Kahn. It basically looks at the housing boom that occurred going into the financial crisis. Chris talked about that this morning, and is to some extent related to the deviation of actual policy in light blue at the top from a policy rule, Taylor rule deviation it's called. So that's some other evidence for it. This is a very interesting survey. You may not remember this. I didn't until I looked at it recently. So John Hilsenrath of the Wall Street Journal did a poll back in 2010, so shortly after this period, of the number of economists who agreed with the following statement in surveys conducted by the Wall Street Journal this week. Quote, excessively easy Fed policy in the first half of the decade helped cause the bubble in house prices. And the vast majority of the business economists say yes. The academic economists are kind of split 13 and 14. So this has been out there for a while, and I think the evidence is accumulating that it was an issue. This is international evidence for the same thing. This is done by the OECD, also way back when, in 2008 or 9, I believe. And so they just looked at the ideal interest rate for the European central bank countries and how the actual policy deviated from it and how that deviation was related, in this case, to the housing boom. So housing investment as a share of GDP is on the vertical axis, and then the deviations from a so-called Taylor rule on the horizontal axis. And you can see the countries which were really messed up, Ireland, Spain, and Greece, were the ones whose interest rate was too low by this measure, and the others, Germany way over in the left, were okay. So if you only have one interest rate for countries in a monetary union, and this suggests one of the reasons you had trouble in those countries was just the same as before. I won't elaborate. This is a recent chart from the Bank of Canada. This is also related to whether central banks should look at credit conditions or macro conditions. So the upper right-hand corner of this picture is where there was a macroeconomic gap in the sense that inflation was too high relative to your goal, and output was too high relative to what you estimate potential. Those are the macro gaps, but also the financial gap, that is things like credit growth growing too high. And they plotted various countries. You can see their flags in the upper right. So there was a joint problem at the time going into the crisis. And then finally, I think this is the last piece of evidence I have. Yeah, this is a more recent chart by Jorda Chirac and Alan Taylor. It's a little hard to see from back of the room, but they're looking at 3 countries in the Eurozone, Ireland, Spain, and Germany, and they're looking at the ECB policy rate based on Taylor rule, exactly. It says at the top, Taylor rule, an actual policy instrument. And you can see at the bottom, at the top, the biggest deviations are in green, Ireland and Spain. Germany's just okay. And of course, then you look at the mortgage lending in the second chart and house prices to income, the third chart, and they're all quite related to each other. So, while this is not definitive, it seems to me it's adding up to say that there was a problem going into the crisis, and that had to do, at least as I'm describing it, as a deviation from, they just use the Taylor rule, but it could be other rules as well. Okay, so the deviation, I think, didn't work. I didn't emphasize that, but of course you had this great financial crisis. You had a slow recovery, not so great recovery. You had international spillovers, which I'll come back to, but we've already mentioned that. And of course, a lot of small open economies were impacted by this crisis, let alone the slow recovery. And so in my view, there was a lesson And the lesson is we ought to return to monetary policy rules and strategies. And I use the word strategy here to be a little more general. It doesn't have to be a mathematical formula, as you know. It is in our research because we do research with mathematics, but it doesn't have to be. The strategy is perhaps a better word. So just to be sure, there are other views. This is a view which Mark Carney and Mervyn King put forth 4 or 5 years ago. And they basically said, no, it wasn't policy that made the error, it was the world changed. And they illustrate this with this trade-off curve between the variance of output on the horizontal axis and the variance of inflation on the vertical axis. And most models would tell you there's a trade-off between the two variances, not between the levels, that would be a Phillips curve, but between the variances. And in this paper by Carney and King, Carney used the charts that Mervyn King used. They say, okay, yes, of course, we went from a good period at point A, low variance of output, to a bad period at point B, which is high variance of output, even though the inflation rate was pretty much the same in both cases. And so they argue this wasn't because policy got bad going from A to B, but because the frontier shifted. And they saw it changed from a so-called Taylor frontier to the Minsky-Taylor frontier. And this is after Minsky, who argued that complacency perpetuates itself. It puts people off guard, and the financial institutions, policymakers themselves, don't pay enough attention to the risks, if you like, in their portfolios or in the system, and that deteriorates performance. So there are other views. I don't agree with this view, but it's out there. Okay, so the interesting thing is that while I would say this is evidence to go back to a more systematic approach to policy, that seems to be happening in real time. And I'm going to give some examples of this. Now, to be sure, I'm going to be mostly looking at research. As I get, it's always hard to match the research into actual policy decisions, but I'll try to do that a little bit too. I'm going to refer to very recent work. So this is I'll give you some examples. Bernanke, Keeley, and Roberts have a paper where they look at 10 different monetary policy rules using the Furbus model. Thomas Mertens and John Williams, John is the president of the New York Fed, did the same thing with the new Keynesian model. Eric Sims and Cynthia Wu are looking at different policies for quantitative easing, and they're looking at structural models. So in a way, this is a development which I think is pretty dramatic just for in 1 year. So these are the rules, just so you can glance at them a minute, in Bernanke and Keeley Roberts' paper. And so it includes something like the Taylor rule at the top. It includes something like the Smith-Vatters rule number 2, and a bunch of other rules. They have one, the Reif-Schneider-Williams rule, which is to deal with the zero lower bound, so the interest rate doesn't go below 0, or -1 or something, whatever happens to be. And then they examine these 10 different rules using a particular econometric model, a Furbus model, and decide which one works. And so that's an example. This is another development. So in dark letters, I have this other development that there's been now a whole new section in the Federal Reserve's annual report, semi-annual report, which includes policy rules. And people have been looking at those, including myself and John Cochran and Volker Wieland and others. And so here's a picture of that. So again, just glance at this. You can go look at the publications. This is the most recent monetary policy report of the Fed early this year, and it has 5 different rules. And it examines whether they're good or not, and it says where the Fed is relative to those rules. So this is a change. This began in 2017. They hadn't published anything like this before. So again, it's an example of, if you like, a revival. This revival of rules has, in the last one here at the bold, if you can see it, there's new measures of discretion versus rules that are being investigated. That's part of the revival, if I think of it that way. And one example is Nikolska, Reshevsky, Papel, and Prodan, just the recent paper. And so to do that, they develop new measures of discretion. So this slide just describes what they do. And new measures of discretion are looking at how the performance of the economy would be, this is US, if a rule had been followed or if the rule had not been followed. And so you can examine, was policy good or bad or better or worse, depending on whether rules were followed. So, you know, with improved computation, you can do this routinely with lots of observations. So these guys do a calculation repeated for 400 rules of the same reform, interest rate reacting to output and inflation, and they take 20 different values of each of those parameters for 400. And then they look at the ratio of discretion to rules, that is how high was the loss in discretionary periods, that's where you deviated from the rule by a certain amount, and they find that it's much greater than one for all the rules, but moreover, I'll show you this picture. Well, let me show you this picture. This is a heat map they use, and it's basically showing that you get a better performance with these rules reacting to reasonably high numbers, that's the green, and not as good for the lower numbers, that's the red, but these are all greater than 1. So in this particular case, they can't find any periods where the rule does worse than discretion. Again, discretion is measured as a deviation from a particular rule. Maybe you would worry about that measure, but it's one approach, and what else are you going to do? Okay, so those are examples. Now, I also think it's worthwhile mentioning that there's been reference to these ideas at least until very recently at the Fed. And so there's actions and statements that correspond with that research that I mentioned at the Fed. And so here's some examples. This is an example of the action. Okay, so this is the federal funds rate. This is a chart from the BIS. This is the federal funds rate in blue, called policy rate. And I circled actions at the end, since that's the developments in the last couple years or so. And then I also show the Taylor rule in green, and deviations from the Taylor rule with the spreaded pinkish thing. So the BIS does this. First of all, you can see the rates too low for too long in 03, 04, 05. But what I'm emphasizing now is this action, which is returning back towards some kind of a rule. Now, the rule that they're using has a band because they're using different estimates of inflation in the gap. And it looks like it's somewhere between 3 and 4. And so that's obviously lower where the Fed is now, which is roughly 2.4. And so, but it's moving in the right direction. And of course, there is a question whether the Fed will continue or not. That's an important question to examine. So those are some of the actions that are consistent with this. But then there's lots of statements. So I've got a few collected here. One, previous chair of the Fed, Janet Yellen, in January of 2017, she describes the Fed strategy and describes it in words. So when the economy is weak, we lower short-term interest rates. When inflation is too high, we increase rates. Well, that sounds obvious, but that's a policy rule. And then she compared that with the Taylor rules I just showed you. Stanley Fischer was the vice chair of the Fed, gave a speech in February of 2017, sort of the same kind of message. And then in early 2018, when Jay Powell first testified as chair of the Fed, he was quite positive about this and said, I find these rule prescriptions helpful. Larry Kudlow, who still is the director of the National Economic Council in the White House, thought that was progress. And then the Fed created a website on monetary rules. And I quote here from the current vice chair of the Fed, Richard Clarida, which is basically, he calls it data dependent, but data dependent means rules. So I think these are statements to go along with that, which are kind of this revival. Now, I should say, the very current, there's huge questions about what the Fed is going to be doing soon. It may be different than this, but we'll have to see what exactly happens. Okay, what explains this? If you buy all I've said, what explains it? And I think it's an interesting question to ask from a research perspective and just a historical perspective. And remember, this is explaining relative to a rise of this approach in the 70s, 80s, and 90s, a fall off in the past 15 years. And I think part of it is just revealed preference by the policymakers and those interested in policy. So again, a very recent paper by Steve Cicchetti and Kim Schoenholz found, this is a survey, did an actual formal survey, the most frequently mentioned topic that they found of all things analyzing policymakers and watchers is the desirability of a clear understanding of policymakers' reaction function. I have a couple central bankers here, Raghu Rajan, who was ran the Reserve Bank of India, what we need are monetary rules, and even Mario Draghi. We will all clearly benefit from improving communication over our reaction functions. So those are one possibility, is just sort of a desire for some clarity, and one can analyze why that might be the case. Maybe the disappointment of policy, maybe just the need for better descriptions. There's also an important motivating factor is that is concern about the effective lower bound on interest rate. It is lower in Europe. It's lower than zero in Japan. It got nearly zero in the US, and there's questions about what to do next. How else would you examine this question other than think of policy rule? What would you do to answer it? And there's really no other way. I think that's why all those papers that I just referred to are moving in this direction. If you're going to say, what should policy do with the zero bound, even if you're focused just on interest rates, you'd like to know that. And there's work on it. I just gave you some examples. I think the disappointment of monetary policy and leading into the crisis has got to be part of this. Again, everybody doesn't agree with it, but enough do that I think it's an issue. And then I think in the other point I mentioned, you had recognition that to really evaluate the impact of quantitative easing of large-scale asset purchases, whether they're treasuries or mortgage-backed securities like the US, or whether they're private bonds in Europe, whether they're corporate equities in Japan, you really have to have some kind of rules-based approach to do this. And so people are beginning to think about strategies or rules for large-scale asset purchases, and including Brian Sack, who used to work at the Fed. A couple other possibilities. There was a policy rule legislation proposed in the US. It passed the House of Representatives, came fairly close to passing. That would require that the Fed stipulate its policy rule. Well, maybe rather than have the legislation, they want to do it themselves. And so that's a motivating factor. They say, hey, we don't need that legislation. We'll just do it ourselves, and maybe they do it themselves. And then finally, if you can see at the bottom, I wrote concerns about threats to independence. I think to some extent there's lots of people making statements about what central banks should be doing. Frequently it's lower interest rates. Frequently it's worried about the exchange rates. What's the best way to combat that? The best way to combat that is, well, we have a strategy. Here's our strategy, and this is what the rate. If you don't like our strategy, then talk about the strategy. But just don't tell us whether the rate should be higher or lower. That doesn't help anybody. So that could be the other reason. I don't know. I'm not a monetary policy maker, so I don't know which of these is the most relevant. Okay. There are some interesting features of the revival, which I'll just summarize quickly. One, for the most part, these are rules in the research that look at reaction functions for the instruments. So the interest rate, give some examples where it's the money supply, but only in Ireland. Give some examples where it's bond purchases, SIMS and WU. So they're not really forecast targeting in the sense of looking at what policy will bring your forecast of inflation to a particular number, or your forecast of inflation or GDP to a number. It's actually a reaction function. There's also very few, thus far, studies which have the instrument being quantitative easing or large-scale asset purchases. There are some exceptions, which I mentioned. They're using Taylor rules to look at LSAPs. And there's a question of why there's so little of this. If you do think it's useful to have strategies or rules for policy, why is there so little? I think perhaps this may be really there are fundamental doubts about the impact of quantitative easing. I know there are doubts in the US. I don't know if there's many doubts in Europe. But here's some examples of the doubts. This is a very recent paper by Jim Hamilton. He presented this at a conference we had at Stanford. It was also discussed at the Fed's conference in Chicago. And it basically looks at in this case, the interest rate movements during periods of quantitative easing. And in all cases, the interest rate goes the wrong way. And so whether you think this is correct or not, anyone who says quantitative easing works to lower rates has to answer this question, has to say, why is this happening? What's the theory that while we think QE reduces interest rates, what is the mechanism that makes Hamilton find it goes in the other direction? And I'm urging policymakers to think through this carefully. There's announcement effects, there's different kinds of things that can occur, but I don't think that's been resolved. There's just another picture from Hamilton which says the same thing, and I'll just skip over that since it says the same thing. Okay, another key feature of the revival, and I've got to watch my time here, is that almost all the policy rules that people are looking at have the coefficient on the inflation rate greater than 1. That's sometimes called the Taylor principle. And the reason I mention that is that it has a huge impact on how you think how policy works. There's something called a forward guidance puzzle, which is discussed a lot in monetary policy circles these days, which says that a small announced change of, say, the policy rate, the federal funds rate in the US, 2, 3, 4 years from now, has a big impact today. It turns out that's not true if you have policy rules that you're deviating from, which follow this principle. And I worked that out in the paper, which you referenced to, but I don't have time to go over it now. But just to say what it is, in this paper with Leela Malar and myself, we showed that forward guidance doesn't arise with, like we call sensible assumptions, maybe that's an exaggeration, but assumptions which include the so-called Taylor principle. And of course, all of the work by the Fed assumes that, and they actually say this is an important principle to have. So anyway, the simple new Keynesian model, which I'll skip over, shows that. Now, let me just take a minute or two to talk about the international, because I think this is very important. It's also very important for smaller open economies. So all I said here about the U.S. Applies to other countries, but also applies globally. And for example, you can use international models, just like the models I showed you a few minutes ago for single countries, to see which rules work better. And my observation is there's been less of a revival of this kind of research. A lot of the revival is more on individual countries. And I think that's a very important missing ingredient. And I was happy to hear Chris talk about an international framework this morning. So the reason why this is important is you can begin by going back to this plot I showed you a minute ago. This was the change in policy at the Fed as represented by the BIS. Okay, well, if you look globally, a very similar thing has happened in the long scheme of things. It's pretty amazing. This is also a chart from the BIS. It's not my chart, this is the BIS. And so they are looking, this doesn't go to 2018 or 19, it stops 2017. But it's the same idea. But they're looking at the average interest rate globally and then average interest rate among emerging market economies. That's the solid blue. Then they look at the mean Taylor rate. That's the average. I'm not mean. It just means it's the average Taylor rate, and it's shown in green for the different countries, and then a spread, as I mentioned before. So you see this same phenomenon generally, and the too low for too long began 2003, 4, 5. It's pretty clear. Central banks got on track for the most part during the crisis, but then this gap continued to continue later. Okay, so there is a question about what's going on here, and I do think central banks are following each other to some extent. That's part of the reason. To analyze this in modern times, you can't just look at the interest rate because many central banks look at quantitative easing as well as the interest rate as their instrument. And so to examine to the extent there's a relationship among central banks, emerging markets, or developed countries, you have to look at some measure of quantitative easing. So I've been doing a lot of that. And this is a quick summary of that. I'll give you a couple other summaries. This is just a correlation matrix between the interest rates, Europe, Japan, EU, and Switzerland. So it's 4 larger countries in a small open economy. That's I. And the R's are reserve balances for those 4 countries. Reserve balances are just another measure of the size of the balance sheet. In order to purchase assets, central banks need to get the money, and they get the money from deposits of commercial banks at them. Those are reserve balances. Okay, so we already know there's this correlation among interest rates. That's the red over in the area. Again, this is just the correlation matrix, 2005 to 2017. And very high correlation between Switzerland and Europe, 0.97, for example. But there's also a very high correlation between the measures of quantitative easing, so you can't ignore that at all if you want to think about an international arrangement. And then the negatives are just the correlation between the interest rate instrument and the reserve instrument or balance sheet instrument in each of the countries, which they're quite naturally negative because a lower interest rate is the same as a higher balance sheet in the views of many central bankers. Okay, so that's just the data, a very quick summary. But here's a time series chart that also describes this. Okay, so these are reserve balances for the US, RU, Japan, RJ, and ECB, RE. And the period goes 25 through 2016. And I'm also plotting the dollar-yen exchange rate in between. So you can see the QE began in the US in red in 2009, 10, 11, and started to fade away. Then you see the Japanese in green and the Europe's in dark black. And you see originally the yen-dollar exchange rate depreciating substantially with that's the dollar depreciating against the yen with the quantitative easing in the US. And so there is an exchange rate effect of quantitative easing in the US. This is a correlation, but I think there's a lot of evidence that says it was the case. When Abe ran for prime minister, he complained about the high value of the yen. He appointed Kuroda to run the Central Bank of Japan. Kuroda does his own quantitative easing, and you can see the dollar-yen exchange rate reverses as the quantitative easing began in Japan, RJ. And then the last part is Europe, which is really the same story. Draghi spoke at the Fed conference in Jackson Hole in 2014, said the euro's too strong, we need to do quantitative easing, and did the same thing. And so there's something else going on here, and that's why I think it's very important to think about this issue globally. I'll skip over those two charts. So in my view, you need to have an international system which is more rules-based, not just one central bank. And one of the reasons for that is we are doing other things because of the correlations that are caused by monetary policy. So if you believe the charts and the correlations I've shown you, it would suggest that some of the movements of capital flows, some of the movements of exchange rates are in fact due to these very unusual policies. In fact, the IMF has recently encouraged countries to use more capital controls because of this effect. And it's called the IMF institutional view now. And I quoted from one of the papers coming out of the IMF, the capital controls to stem inflows in the wake of historically unprecedented economic and monetary policies by the Fed, ECB, and the BOJ. So it's not often mentioned, this may be the source, but this I think is one of the reasons why you've seen more interest in capital, controls on capital. And I know there's lots of discussion about that in Morocco at this point. But they can have adverse effects. Also, to the extent the monetary policy affects exchange rates, it causes all sorts of political issues, calls for competitive evaluations. Why can't we do what Europe did, for example, would be a statement that you would hear. And so that causes political instability. So this is one of the reasons why I think a more rules-based international system would work better, and I'm not going to go into that. I just served on a committee. It's called the, I don't know why, Eminent Persons Group that the G20 appointed, and so one of the recommendations was to move off of these capital controls. And what that would create is, I listed at the top some principles of an international monetary system or reform, which would not only have this rules-based monetary policy, as I mentioned in the third point, but flexible exchange rate between currencies or blocks and open capital markets. So we're clearly not there at this point, but this seems to me a reasonable goal to work for eventually. Okay, I just maybe, I think, mention, to me, there is a important relationship from a reform perspective among countries, and it would be easier, I think, for normalization to occur, say, in Europe, if the Fed normalized. And indeed, as the Fed began to normalize in 2017 and 2018, you saw some changes were occurring in Europe. Quantitative easing stopped for a while. There was even talk about changes in interest rates. The Fed seems to have deviated recently, so perhaps that's not happening anymore. And I think this is a very important thing to do. In a way, it's an attractive approach because each central bank can do what's best for its own country, and it creates global stability. But this is one of the points I'll end with. I think we need more research on this than we have now to, if you like, prove that I'm right. But I think the macro models we have suggest this is the case. And the macro model database that Volker Wieland is working on in Frankfurt would be a way to do that. Okay, so I'm going to wrap up here. I have more charts, but I think in the interest of time, I'll stop. There are implications for research. And first of all, well, I do think what I've said here and what other people are thinking more and more about is that strategies and rules look pretty good. But they don't look good when they go away. They're as good as they last. And I think even expectations of a return to rules affects expectations positively. And I think that's an important thing to think about. So even if you're deviating for a while, the notion you're going to get back is important. So the question is, what can be done about this? What can econometricians do? What can we do as researchers? And I just listed some things here, and I could go into all of them in more detail. So first of all, more robustness. A lot of the example that I went through, the 10 rules of Bernanke, Keeley, and Roberts, one model, FRB-US. Actually, let me just do a quick chart of that. This is the FRB-US model looking at different rules. And the rule that comes out over here is best, is way over on that side. If you take the same kind of model, Smets-Waters model in Europe, and the ECB uses, you get exactly the opposite. And so there's a real issue about what models are being used, and that's, to me, a call for robustness. And so I've been working on that, as have others. And I think the databases like Wieland are important. I think what Chris described today is an important aspect of this. You need to have more kinds of models to analyze this, especially internationally. You also need to think about how changes in models affect rules. There's a big discussion globally, began in the US, I believe, about whether the equilibrium interest rate, sometimes called R star, in a Taylor rule is now 3 rather than 4, or 2 rather than 4, or whatever. And that's an important issue, but you can, of course, adjust the policy rule to that pretty straightforward. It's just assume the coefficient intercept is 4 rather than 3. But there's other things that are more difficult. People are saying, well, the Phillips curve doesn't work anymore. It's too insensitive. Inflation's too insensitive to unemployment. Well, how does that apply for the policy rules? One can calculate that and have estimates of it. So there'd be changes in the models. I think it's important also that when central banks think about models, they're to some extent designed not just for forecasting, which is essential, but also for evaluating policy rules. You know, it depends on, sometimes you don't need a gigantic model to evaluate a policy rule. It can be simple, but you need to have quantitative easing in it if you want to examine the impact of quantitative easing. So I think just generally speaking, if you had this notion that, well, we like this model because it can help us evaluate interest rate rule or money supply rule or whatever it happens to be, that's an important thing. And I think also this, I'll call this interface between rules and decisions. It's very easy for decision makers to have a research department, and those people in the research department just do lots of work on rules, models, greatest and latest they want, but then they don't pay any attention to it. And so this interface between the two is very important. Again, that's my experience, being a researcher and being in policy many times. And that interface is important. To some extent, it's having the decisions related to the policy rules or the models to some extent. It's having the policymakers familiar with them. But I can't emphasize that any more than I just did. And I'd say the rules or strategies should tend to focus on the instruments rather than on forecast targeting, and I referred to that already. So there's lots of implications for research, which I think it would be great if people did. And so skipping over that, I think I have a concluding slide. Yeah, see how much I skipped over? Yeah. So what I've tried to do is give you a little history in honor of the Econometric Society and the Bank Al-Maghrib. Path-based, rules-based, retrogression, and revival, you know what that means. I think there's no question that research has had a big effect on performance, good or bad. I mentioned there's been this revival of rules. That's kind of my interpretation. I don't know if everybody would agree with that, but there's certainly evidence for it. Instrument rules are very popular. Maybe it's because of disappointment in what happened. Maybe it's because of the need to investigate the effective lower bound. We've had new measures of discretion, as I mentioned, and so far little impact of quantitative easing on rules. And so the implications, robustness seems so important for me. More international models, they have kind of disappeared from the scenes recently. I'm not quite sure why. And to try to, if you're interested in quantitative easing, investigate that with some kind of a monetary policy rule rather than just one-time change in the instrument. So I will stop there and see if anybody has any questions. Thank you.
Thank you for your presentation, Mr. Tyler, and thank you for coming from Morocco. I have a question about monetary policy rule. I want to know, for example, for unconventional monetary policies adopted by, for example, Bank of Japan, European Central Bank, Federal Reserve, or Bank of England, you think that we can have a policy rule for some instrument like forward guidance, quantitative easing, or credit easing, because for example, for interest rate, we see your presentation about Tyler rule, but for instrument like, for example, forward guidance, that's it, or complicated instrument. I want to know that if you think that we can have a role for instrument like that. Thank you.
So I think it's a good question. I think it has to do with how practical it would be for a monetary policy official to have a rule and what happens when there's deviations from the rule, right? So deviation might be a forward guidance operation. Very good question. My sense is that there's quite a bit more that could be done, depending on the central bank, about thinking about rules and talking about rules. And I emphasize it doesn't have to be mathematical. Again, as researchers, we will automatically make it mathematical. We don't have much choice. We can work at it, but you need this possibility of thinking of deviations. So the way I thought about it is the central bank can be clear about what its strategy is. And it could be just like what I quoted Janet Yellen as saying, we raise interest rates when inflation rises, we lower interest rates when unemployment rises. It could involve a little more magnitudes than that. I think it would be good. I think the Fed has already begun to say that the coefficient on inflation should be greater than 1, so that's going in the right direction. I think if there's a exchange rate reaction, some notion of that should be mentioned. At the U.S., they say there isn't, so it shouldn't be mentioned at this point. But all those things are quite a bit more than what central bankers normally do. Not all. I mean, obviously some go further than others. There is a question about when you deviate. And here I think is this, as long as there's some explanation about why you're deviating. So in the US, the chair of the Fed goes and testifies, and he or she in the future will have a press conference after a meeting. So it's very possible to say, well, we are worried about X, and so we are deviating from our normal. Maybe deviating is even too big a word, too contentious a word. We're doing something different for a while because of X. And then I think that actually would improve a lot. So my view is that if that were in place in 2003, 4, and 5, it would have been very hard for then Chair Greenspan to go, we are holding our interest rates extra low compared to the past because, what would he say? Well, he might say we're worried about deflation, but at least there could be a discussion, and I think that would at least prevent some of these deviations. So again, the rules are not perfect and they change, so I would say this idea that R star, the equilibrium interest rate, has come down, say, from 2 in real terms to 1, say, they talk about that all the time. And so that could certainly be a part of a rule. Well, the rule is now 1 rather than 2 in the rule. And so I think there's lots of ways that this can be done. And to some sense, it's a statement about policy in general. Policy is going to be better if people understand what it is. And that's whether it's tax policy or regulatory policy, whatever. This is sort of an extension of that. It's maybe harder. And then I would finally say if somehow we could get to an international system like this, I think it would be sort of people would expect it, and there wouldn't be as many surprises as there are now. You'd have some idea of what was going on in monetary policy in areas where you didn't have any idea now.
Thank you very much for your talk. I find the chart on Minsky and Taylor Frontier quite interesting. It seems to link financial stability together with output, volatility, and monetary policy. And it reminds me of the view that monetary policy being used as a macro-prudential regulation. And I wonder what your view on that is.
Because I understand that you're referring to the chart where there's a relationship between the variance of inflation, the variance of output, and it's a curve, and that is a property of many, many models. It's pretty stable, people found. So it's kind of just another way to characterize models to me. And it may be better or worse than other purposes. What I've found it's useful for is saying that there is no long-run trade-off between inflation and unemployment. I believe that. I don't think there is. I think that was thrown out of thinking a long time ago. But there is this relationship between the variability of, and that does come from the macroeconomy. You just plain old, a little bit of sticky prices, a little bit of the impact of monetary policy in the economy, and you get that. It's also, I mean, the King and Carney used it in a way which I don't agree with, but at least it was a way to debate the subject. So that seems to me in the right direction as well.
So, sorry. My question is about small countries like those that we find in Africa and this need for rules to be applied for monetary policy, and particularly in the case of Morocco, for which a banking act has been adopted recently regarding participative finance, which is Islamic finance, in which the interest rate should be not integrated in the system. So what do you think? The interest rate is considered sometimes as exogenous variable. So can we take the return, the mean return of real economy as a benchmark for, and a rule to take it as a rule for monetary policy in dual system in which we have conventional and Islamic finance? Thank you very much.
So just to be sure, you were asking about how Islamic finance fits into this? Yes, okay.
I'm asking about if we can replace the interest rate to monitor the economy of a country in which we have an Islamic Banking Act, and since the interest rate is considered as exogenous, can we take the mean return of the industry as real economy? Thank you.
Yeah. So I think in terms of Islamic finance, it seems to me it's possible, I've thought about this, how to translate these kinds of things into interest rates, if you can use the word. And I think I've thought about this a lot, not in the last 2 or 3 years, but before. And I don't think I worked for a long time setting up the new financial system in Iraq, the new Central Bank of Iraq. It was one of my favorite jobs. So you had to think about these, maybe not my favorite job, most interesting job. So you had to think about these things. So I think it's certainly possible to have the right interpretations, because you do have interest rates that are coming from the markets and from the world, they're there. I think one part of your question, though, which is important, is sort of what is subject to control of the central bank. And here I think it's important. The real interest rate, I think that's someone else. That's savers, that's investors, that's return on capital. But they can't affect the nominal interest rate because they can affect the inflation rate. And even more than that, in the short term, they can affect the nominal interest rate because prices are rigid and they can move it around to some extent directly. So I think people recognize that, but they can't affect certain things, and I don't think they can affect the long-run unemployment rate. Maybe there's debates about that, but I don't think so anymore. I think that's been resolved. And at least if you want to debate it, it's not by much. It's not compared to the inflation rate. So I think there's more things that you can agree with. That's what I'm trying to get to, and then emphasize disagreements. And here, there is a lot of different views. Monetary policy, maybe more than the other subject, has lots of different perspectives and views, and new ones come up every day. We have something called modern monetary theory, which is popular in the US. So I think you just have to emphasize what's similar, have good arguments against what you don't think is right, and move on with that. Anyway, thank you for the question.
Thank you very much for your exhibition. My question is this. Okay. According to the last speech of the arguments of Olivier Blanchard and Larry Summers, may I ask you from your perspective if the 2% inflation targeting still matters, and when we have to take into account the spillovers of the rise of geopolitical tensions, and also the trade war between the U.S. and China.
So two very good questions. So in terms of the tensions, so I'm indicating here a system which is pretty straightforward. Each country could do what's best for itself, assuming other countries will do the same. There's obviously a very tight relationship between the countries. So there's no need for other kinds of interventions. That message seems to me important for the real side of the economy too. It really, the analog for that on real side would be more free trade, right? That would go in that direction. So it seems to me that if you're at one time arguing that we need a lot of special interference with markets on the financial side, that's going to carry over to the real side, and I don't like it on the real side. I think it's a problem. So there's a relationship between the two, which I don't think is irrelevant. I'm sorry, what was the other part? Your question? Sorry.
The question was concerning the fact that if the 2% inflation targeting still matters.
Yeah, I'm sorry. So there's another very important question now, and it's related to this R-star thing, is that we're going to have a near zero interest rate for a long time. And so people like Larry Summers, Olivier Blanchard have argued, well, we just should have a higher inflation target, so the interest rate has more room to move. So instead of a normal interest rate of 4, you have a normal interest rate of 6, and so there's more room to cut it. So that's out there. I think they both proposed that, and others have proposed it. I don't think it's a good idea. By the way, we're still having trouble getting to 2, and so that's going to imply a lot of other things besides. And I think to me, we're pretty close to 2. It's okay, but 2 is the target for many central banks. So I don't think it would be a good idea to go in that direction. We've got such a consensus internationally about something like 2. It took a long time to get there. I think it works pretty well. The problems seems to be, are not the zero bound. The problems we got into are because of other issues. And the more we can look at we have some proposals to deal with the zero bound. They continue with the 2% inflation target. So it seems to me that works pretty well. There's another thing which this debate has led to, is pretty amazing to me, is at least in the US, there's very little concern about the budget deficit. It's like people are complacent about it. It doesn't really matter anymore. It's quite a bit of change. And I've written op-eds about this, and I've never been attacked more in my life than saying the budget deficit matters. So there's something out there, and it's to some extent related to the debate that Olivier has had. So that's a completely different subject, which we could get into, but I think it's a very important one to address.
Thank you so much for the great presentation. Recently, it's been discussed that the international monetary system is mostly affected by the dollar-dominated economy, and that the Fed's spillover effects of its policies depends on the level of USD invoice trade in the recipient countries. In the same way, for the ECB, if a country has a high level of its trade invoiced in the euro, then they are more susceptible to spillover effects of the monetary policy in the eurozone. And so I just wanted to hear your thoughts on that, in a dollar-dominated global economy, what is the place of a rule-based monetary policy if international cooperation can help, or if you think that if there's a decline in the role of the dollar in the global economy, if there will be less spillover effects? Thank you.
So I think the case for a more systematic, strategic, rules-based policy globally is pretty much what I've tried to emphasize for a single country. It's more complicated and it's more controversial. But if you take, I think, reasonable models, multi-country models, and you ask the following question: would there be a policy better than each country having a policy rule for themselves? And the answer is, of course, yes. You can, because you can take into account everything there. But it's very small. It's a very small addition. And you could argue it's impossible to do that. It's impossible to have a world monetary policy of some kind. So instead of that, you have something which is very close. If you like, it's a Nash equilibrium is almost the same as the optimal. It's very close. And I think that's what some models show. The models that I have used in the past show that. I'd like more models to demonstrate that. I'd feel better about it. I think it'd be easier to persuade people. So that does raise the question of how general could you make that statement? The models I know are a relatively small number of countries. They don't include every country in the world. And I think you need to go beyond that to think about some of the questions that you're raising to look into that, because it does seem a bit of a stretch to someone. Well, how could it not possibly matter that the U.S. doesn't pay attention to its exchange rate? Well, it matters because it reduces exchange rate volatility, and it's just fine if it doesn't. So I think this is really where models can be really useful, because they can really tell you whether this is close or not. Again, I think it's close, but we don't have that many models anymore that are international and able to answer this question. So I would do that. And then in terms of special small open economies, I think, currency zones, there's no reason to rule those out. You have to worry about, like in some of my charts, that one interest rate doesn't fit all. And what are you going to do? Somehow an agreement about the interest rate being good for all the countries is important to do. But I think probably you want to have something like that in addition to every single country having a flexible exchange rate. And there are alternatives, of course. There's possible is to have literally a fixed exchange rate. So I would think about those as well. But the overall goal is you have open capital markets. So even that sounds controversial. How could you possibly have open capital markets? Well, the U.S. has open capital markets. Most of the European countries have open it works okay. And you worry about the flows in and out, but they're reduced quite a bit by the different monetary policy. So I would like to see more work on that as well. I certainly don't want to see things that continue in that mode. And again, I mentioned the IMF's institutional view, which is in a way trying to argue it's okay to use these restrictions. I don't think it's so okay. If you have them, how you can get rid of them, what's the gradual way to do that? But going that direction seems to me not the way to go at this point.
Okay, thank you very much, John. I like the way you started by tracing the history and bringing us to the future, and I very much agree with you about the revival of these rule-based policies. And I've actually been a big fan of your works for years now. I have one question in the context of the kind of economies we have in Africa. So you have economies where we find that there is fiscal dominance. So in this new revival for rules-based monetary policy, do you see a future in which there can be a way to weave around monetary and fiscal policy type-based rules? I just heard you talk about the fiscal deficit. I'm wondering if this revival can have these interactions and coordination between monetary and fiscal policies from your thoughts. Thanks.
So if I understand, thanks for the compliments. I think that fiscal policy, it would be better if it was more rule-like. In a way, I've always argued that the best fiscal policies where the automatic stabilizers are pretty clear, so that you're running a deficit in a recession and you're running a surplus in a boom. That's sort of the automatic stabilizers, and they do provide some predictable stabilization. I personally don't think the discretionary additions to that add very much. They cause uncertainty and confusion, and you can get a lot out of the rule-like fiscal policy, automatic stabilizers. So again, we're in the U.S., we're a bit away from that at this point, since there's quite a large structural deficit in the economy at this point in time. So I think it'd be better if you could think of fiscal policy in the same way as monetary policy. There's no fiscal agent, just like a central bank, so it's difficult to do. There's politics that get into it in a much more difficult way. But my research over the years has shown shifts in philosophies. For a long time in the 80s and 90s, there was a sense in which automatic stabilizers were fine. We didn't need all the discretionary policy. Then there was a discretionary tax cut in the U.S., and then, of course, during the recession quite a bit, too. So I'm not sure where it is right now. If there was a downturn in the U.S., probably in any country, there would be call on fiscal policy, but the deficit is already so large, it would be much harder to do that at this point. But if I understand your question, this approach to me is there's a commonality on policies that should have this property, more predictability, more rule-like, and tax policy, fiscal policy more generally would be part of that.
Thank you. I have two questions. The first one is about what we call, monetary policy. We use a lot of variables, and even in your rule, in Tyler's rule, we are talking about the equilibrium of interest rate, of inflation, my question is, in emerging markets, we have a lot of reforms. This is the impact. There is a lot of change in the economy. What do you suggest for this economy to have a good measure for this equilibrium level of this variable? Sure, we can use statistical method, but if you have considering your experience, some suggesting this is very important. The second question is about, now we are looking for the Fed. There is a lot of discussion about the new strategy of monetary policy in the USA. Well, have you expectation about this? If you expect maybe there will have a big change, which will be change the the framework of monetary policy was just a discussion because after the crisis, I think there is a lot of critical things addressing to monetary policy in the advanced country mainly. Thank you.
So it's a very good question. So I, as you can see from my talk, have my own views about a few of these things. But I don't think for that reason I want to discourage research that might find another view. It's just fine. And I think one example is the world changing. And well, of course it's changing. The technology is changing. It may be that we'll end up with some alternative currency that avoids all these issues. And I certainly wouldn't want to discourage research and thinking about that at all, whether it's cryptocurrency, whatever it happens to be. But in the meantime, the issue which I think people are talking about the most is this lower bound, whether it's -1 or -0.5 or 0. And there it seems to me, of the long list, say, that I gave you from Bernanke, Keeley, and Roberts, the one that makes the most sense is this Reif-Schneider-Williams proposal to me. And I think the reason is for that is a rule. It's a meta rule in the sense that when the interest rate hits 0 or the effective lower bound, that the central bank counts how many periods it's at that bound and has a policy, we will stay lower for longer by the proportion of that time. And so that's mathematically well constructed, and you can analyze it and work with it. Maybe something will come out. But I've always been gravitated towards that as a way to deal with the change in the economy. But more generally, there's all sorts of changes in the economy going on all the time. And I don't know, it seems to me people are always looking for new ways to do things. Well, the old ways work pretty well sometimes too. And so don't throw those away too fast because they may be just what you're looking for.
We take two last questions, one here and one there.
Okay, so I see some sort of a conundrum here when it comes to the implementation of monetary policy, rules-based monetary policy. So on the one hand, we can't really look at the data because presumably central banks have not been following recently, at least the standard rule. But on the other hand, when we consider large models, large macroeconomic models, and we attempt to derive optimal rules based on well-defined welfare criteria, well, it turns out that the results are really model-dependent, extremely model-dependent, not only in terms of the coefficients in front of the output gap of inflation, but also in terms of the arguments that enter the rule. So what should we do? Which criterion should we use to base our decisions on?
That's a tough one. So I don't know. We have 2 or 3 members of the FOMC now who've done huge amounts of research on rules, John Williams and Richard Clarida. And so they have to make decisions now, which I assume they've not completely separated from their research. They're still writing. And so they're thinking about this, I hope. I know they are. And so I would be if I were in their shoes. You're thinking about the world will change. You have to have a strategy that kind of works generally. If there's a big change, you try to react to that, but be clear as possible about it. So I don't really see that as much of a problem based on my talk here is basically saying the problem is not that they didn't follow the rule, it's that they went off the rule. And to some extent didn't explain why. Now that's not always the case. Sometimes they explain why and it just doesn't, to me, doesn't add up. So there's a debate about that. But it's always in the context of some framework or strategy or rule that you're discussing. It's not completely abstract. It's not change the interest rate today, we don't care why, just do it. This is part of our strategy to keep inflation low and steady, part of our strategy to keep credit from booming, part of our strategy to keep the business cycle reasonably narrow, part of our exchange rate strategy, all those things that are there. And that would be the way that I think works pretty well. Again, it doesn't have to be mathematical. It will be for the researchers because they have to analyze the proposals. And maybe that's part of this interface between the policymaking and the research, which the people have to face up to that to some extent. It occurs in all areas. You know, if you examine the effect of a tax reform, it's not going to be, the thing that's enacted is not going to be exactly as in your models. So I think we can deal with that. Thank you.
My question about another perspective of the monetary policy. It's actually about the link between the micro side and the macro effects of the monetary policy. As you know, in the Austrian theory, we are talking about the link between everything macro and micro, which is, in the case of the monetary policy, the accumulation of capital. And then I think we find a lot to say about the case of Morocco, for instance, about what is happening in terms of the process of the capital accumulation, since that we see that the central bank is making a lot of efforts to have a very low directive interest rate, but still the investment behavior is not responding. So do you think we have to refer to this kind of exercises? Thank you.
So I think this is an issue which has to do with things that monetary policy can deal with and things it can't. And I think so many things, like there was a wonderful panel this morning which talked about reforms. I didn't mention monetary policy as far as I remember, but it was how to get growth higher, how to be more equitable in the growth. And there's so many things that go in that direction, which is maybe tax policy, regulatory policy, which I think should be the focus. And monetary policy provides a backdrop for all that. But it's not going to make the economy grow faster. I mean, more stability is good and more certainty is good, but the main things are regulation and taxes and openness. And I think there's a tendency for people in general to say, why can't monetary policy do that? I've spoken to many, many central bankers over the years, and frequently a central bank governor will say to me, my government wants us to do this. What do I say? And there's all sorts of things that you say, well, say you don't do that. That's not your job. It doesn't work. There's another part of the government that's important for that. So that's an important lesson that I think should be stressed more, that there's certain things central banks do, they do well. If they try to do everything, I mean, the Bank of Japan is buying private equity. I don't think that's a great idea. Well, what's the reason for that? And it's so on and so on. And we're not over with this. There could be a lot more before we're done. But that philosophy seems to be good. There's other things that are important to get the economy to grow more rapidly. And I think we have a problem around the world on that. And I just don't think it's get monetary policy right, but that's not going to be why we have 10% rather than 3% growth or 2% growth.
Professor Taylor, on behalf of the organizers and of the participants, please allow me to thank you again for this very interesting and very thoughtful lecture. Thank you.
Thank you very much.